Welcome to our number 4 financial freedom seminar. We've had 3, and so today and 2 more. They've been a blessing, and Dr. Crum is going to this time teach us about insurance. So, Dr. Crum, why don't you begin?
Well, first of all, I'd like to open in prayer, but I do thank you for having me here today. Our Father, I pray that as we review the last couple of weeks and then open this big topic of insurance, you'll give us clarity of speech. I pray that those who are watching now and in the future will ask and seek help that they need and give them the disciplines that they need in order to be good stewards. In Jesus' name we pray. Amen.
Amen.
All right. So we're going to move ahead here. I want to remind you that the church exists to evangelize the lost, edify the believers, and we're here because God expects us to be good stewards. The Bible says the earth is the Lord's and the fullness thereof, and we are here to take care of God's earth. So we've been talking about this pyramid. At the bottom of the pyramid is cash flow, which is our income and expenses. And I will review a little bit about budgeting, which came from week 2, and debt, which tends to be the largest expense of many folks, which was last week in week 3. I'll review some of that, but today in a few minutes, we're going to talk about protection. Now, protection comes in the form of insurance, and insurance, simply put, comes in 2 types. One is a cash reserve. That's our personal insurance, where we have money in the bank to cover our deductibles or the small things of life. And the other would be formal purchased insurance. Now, next week, we're going to talk more about the future and investing and planning ahead. And then after that, we're going to talk about leaving a legacy that has less stress. Of course, our legacy is our will. Maybe we'll talk a little bit about living trusts, but there are other ways that we can guarantee that that legacy goes smoothly without being a problem. Just to give you a little teaser for that, on Thursday morning, I had a client meeting, and I said, can I help you with anything else? And they said, we don't have a will, and we have 8 children. And then I said, well, I met so-and-so, and she said, oh, that makes 9. Okay, this was not a traditional family. And as we continued to talk, she was concerned about the stress that would come in dividing assets for those who remain. So I'll give you some tips about that and making that a smoother and less stressful situation here in the weeks to come. But for now, we want to review a little bit of our biblical foundations, and we're going to do things a little differently today. I'll review a couple of the biblical foundations, and then we'll talk about other topics. And as we talk about the other topics, I'll add some biblical insight as we look at those. But remember, the Bible is rich in information and wisdom, and there are at least 2,000 verses that talk about money. Some people count 2,500. It depends on what you count as money. And those 2 verses in between the section on money, whether you count them or not. But Jesus spoke about heaven and about hell about 500 times each. There is a lot more information in the entire Bible about money than there is about heaven and hell, at least in the words of Jesus. So the Bible has a lot to tell us about being successful with money. Remember, there were some wise sayings from Proverbs. I'm not going to review every one of these, but we want to remember that riches don't last. They fly away. Money comes and goes, but we want to plan and have a good life and use the money that we have today as best we can. Remember, we don't want to get lost in drunkenness or other addictions. Verse 23 down here says, buy the truth, don't sell the truth, also buy wisdom, instruction, and understanding. And we gain understanding when we meet together like this and instruct one another in what we've learned and share the wisdom of the ages. The Proverbs includes the wisdom of the ages. Part of that wisdom does address the most difficult things we face in life. And I recommend that you read the Proverbs frequently. Many recommend that you read a proverb a day. There are 31 chapters in Proverbs, and if you read a proverb a day, you'll read through the book 12 times in a year. And after 12 readings, you'll be fairly familiar with it. Sometimes it helps us just to read a few proverbs rather than a whole chapter, though. Remember, Proverbs 22:7. Last week we talked about debt. And no matter how we spell this verse, no matter how we translate it, the borrower is still the servant to the lender. Debt makes us a slave. As we contemplate that, as we look through our notes about debt, one of the lines in the notes says, "Have you counted your lost opportunities?" When I went to work at Pensacola Christian College, Dr. Horton, who started the college, he asked me personally how much debt I had. I said, well, we own our house. We've got a mortgage on our house. And that house was pretty inexpensive. I think I paid $32,000 for that house. It was our first house. And I bought it off my father, who had worked on it as a flip, and the flip went bad. And so I bought Dad out for his expenses. And Dr. Horton said to me, that's good. Many people want to come and work in the ministry, but they can't because they're upside down in debt, and they just can't make it mentally, emotionally, or financially because they are in bondage to a lender. We talked about cash flow, which is our income and expenses. Remember, in Luke, we had a verse, I believe it was about the ravens and the lilies and how God cares for them. But look at this verse. For which of you intending to build a tower or a building doesn't sit down and count the cost to make sure you have enough money to cover the cost? Lest happily, after he hath laid the foundation and is not able to finish it, all that behold, it begin to mock him. Everyone who sees what you've done begins to mock you, saying, this man began to build and was not able to finish. Near our farm in Wisconsin, there are towns, and towns are 6 miles square, so 6 by 6 miles. And our town had about 800 people in it. And then in the center of the 6 by 6 mile, there was a village. That little village had the same name as our town, and it was confusing, but that's the way they did things there. And that little village had just a few hundred residents. But as we drove into that village on the left-hand side, there was a foundation of a home there that was unfinished. It was unfinished when we moved there, and by the time we moved 10 years later, they had pushed in that foundation after changing the fences several times to keep little children from falling in the basement that didn't have a house on top of it. And that foundation was wasted. When we build, or when we get excited about building this tower and start without having a good plan, we spend all of our money building that tower. Then we don't have a tower to use, and we don't have our money, so we've lost twice. This is a verse that we want to keep in mind as we're budgeting, and it also affects protection. We'll learn more about that in a few minutes. Remember, your budget is your buddy because it's like your gas gauge, and it warns you of upcoming trouble while it lets you know how much confidence you can place in the near future. It helps to keep us from that surprise of running out of gas when we didn't expect it. What is a spending plan? Your budget? You just want to know what's coming in and what's going out. But we constantly want to review what is necessary and what is optional. Is it necessary for you to have a big new 3-bedroom, 3-bathroom home? No, it's necessary for you to have a safe place to eat and sleep. And you do need at least 1 bathroom for hygiene. But we don't have to have a bathroom for every member of the house. I can tell you, that's a lot to keep up with. Because by the time we left the farm, there were 2 or 3 of us living in the house, but depending on how many kids were home from college, and we had 4 bathrooms. And that's a lot to maintain when you don't use it. You still have to take care of it. Got to keep it clean. We also talked about the homework of debt. We paid attention to interest and how long debt takes to pay off. I'll review some of those numbers in a moment. But look at this bottom line. When we're in debt, we are exchanging current payments, current interest that we might be able to use for some other purpose. And when we're in the bondage of debt, we sacrifice that other purpose because we have to pay for our past spending. So keep that in mind. Now, in destroying debt, the principle that I've drilled on several times is to pay attention to how money doubles. This is the rule of 72. You divide 72 by your interest rate, And that tells you the number of years it takes, more or less, for the money to double. Now, many of our credit cards, I have a paper right here that just came in the mail. I'm not going to take the time to show it to you, but if you've got a credit card, you've seen it. And it was talking about 23 and 24% interest rates. Now, I don't carry any debt at that kind of interest. My highest interest right now is 5.25%, and that's on an old mortgage, and it's not worth changing the mortgage. Otherwise, I would right now, because mortgages are very inexpensive these days. But it's not worth the cost of changing. I hope to have that mortgage paid off here pretty soon. But if you take 72, for example, and divide by 24, 23, 24, 25% interest rate from a credit card. So you divide 72 by that and you end up with about 3 years. If you are not paying sufficiently on your credit card and you have those crazy high interest rates, after about 3 years, you're not only in the same place you're at, but maybe your debt has doubled. And after 4, 5, 6 years, you end up so deep in it, it is overwhelming and it's very difficult to get out. So think about the rule of 72. The other way the rule of 72 works for you is whenever you are saving for the future. And we'll talk about that more next week. I showed this to you last week, and I'll show this to you again next week in a different format with some different stacking. I'll stack some blocks and things so that you can see what happens whenever you save a couple $100s a month and begin at age 20 or age 30 or age 40. The 20-year-old has a whole lot more money in the end because they've had 1 or 2 or 3 more doubling cycles. Many people used to retire in their earlier 60s, and now they're working till age 70, partly because we're healthier than we used to be and the life expectancy has been going up for many years. But they're also working longer because, for example, if you wanted to retire last month and the stock market fell and the value of your holdings dropped in half, it's really a bad time to start drawing out that money. But as we talk about insurance, and I won't go into great depth with this, but it's good to have both insurance and investments. For example, people who have investments right now and those investments are low, they shouldn't take that money out of the stock because that stock might come back real soon. Some of them may want to borrow money from their life insurance, their whole life insurance policies, and if they borrow that money, it is not correlated to this up and down market. The insurance is very stable while the market goes up and down. The insurance companies take the money, and I'm talking specifically about life insurance at the moment, but they take that money and they invest it in real estate and bonds and maybe long-term assets like office buildings. That's what I'm thinking about whenever I'm talking about real estate. But expensive things on long-term mortgages and long-term bonds, and those numbers don't get all excited whenever the market does this. They might move a little, but they might not move at all because that's the nature of insurance. And insurance and investments, this is a perfect example of what's going on. So we'll talk about investments more next week, but I want to remind you of some of the applications of the rule of 72. The basic deal is how often does the number double? Given a specific interest rate, how often does the number double? When will my pay double? When will inflation double or half my purchasing power? When will the value of my home double? How long does it take? How will my credit card interest increase? So we were talking about pay down methods, and we talked about the snowball method first. The snowball method is the most popular because it encourages our emotions and our ego. In the snowball method, we pay off the lowest bill first, and then we take that payment that we don't have to make to that first creditor because they're paid off, and we apply that payment to the next lowest bill. And once we get that going, it begins to domino, and we gain a lot of momentum. We'll review those numbers in a moment. Now, the avalanche method is very similar, but instead of paying the lowest balance first, we pay off the highest interest rate first. Statistically, this saves us the most money, but it takes more discipline to pay off the high interest rate than it does to make one creditor go away. So if you need the discipline, if you need the encouragement of seeing yourself progress, you'll probably feel like you progress more if you're not writing that one check or making that payment one month. But you'll pay yourself out of debt the fastest by paying off the highest interest rates. It's always good to round up a little bit. After the meeting last week, we were talking with someone about how to pay ahead on your mortgage and how paying ahead just a little bit more each month ends up making or taking a year off of your mortgage. Most people who pay ahead on their mortgage end up changing a 30-year mortgage down to an 18 or 20 or so year mortgage, which saves a lot of interest. And of course, if you want to know more about something, make a note off on the edge of your paper and we'll come back and talk about that later. Or you can email me and I'll get back with you. We looked at a case study. We called them Stan and Susan. They were a young couple. They were recent graduates. They bought a car, and of course they moved. Now these are the same numbers I used last week, but I colored them a little bit to help maintain your interest and to clarify things. They had $88,000 in fixed term loans. That was the car payment for 5 years, 60 months, and the student loan payment for 180 months. How many years is 180 months? That's 15 years. So they had $88,000 in debt. And you want to think they're going to take on another car payment as soon as 5 years are over? Most people do. So they would buy 2 more additional cars, and they're going to be in car debt for the next 15 years and probably the rest of their life unless they stop the pattern. Part of what we're talking about here is stopping the pattern. We have to reset the pattern and determine to stay with it until it's reset, and then we treat it more carefully. A few years ago, a lady called me and asked me to come and help her with her debt. And I showed her how to get out of debt. And I was very kind, but I said, I'm like the doctor, and you've shown me these numbers. Do you want me to tell you how to heal this financial illness, or do you want me to pat you on the back and send you out the door? And she said, I want to know. And I said, this is not comfortable. She said, I want to know. And I said, go sell your new car. And she said, Dr. Crum, no. I said, I know it's important to you. But as the years passed and she connected with me over and over, I had learned that she had been in foreclosure and bankruptcy a couple of times. And she simply did not maintain the discipline to stay out of the hole. Okay, she had some good reasons for taking on some of those debts. The roof was falling apart. She didn't have cash. Roof is important. If your roof is badly leaking, you've got to get it fixed because that water runs down the walls, and before you know it, your walls are rotten, your windows are rotten, and your foundation is rotten, and you're falling through the floor. One of the reasons I bought this house as inexpensively as I did, because the refrigerator had a leak, and below the refrigerator, all of the floor was rotten, and the refrigerator was sitting on a piece of plywood so that it would not fall through the floor. I had a lot of work to do to fix that. Don't let water dripping ruin your house. That's a big tip. Fix it. Dripping water is expensive. It will take the finish off of your bathtub. It will ruin your toilet. It will run your water bill up. And a leaky roof is a problem. But you might not have to replace the whole roof. A tube of caulking goes a long way. It costs $5. Get somebody safe to go up there and take care of it for you, and at least buy you some time. Again, referring to the farm, the shingles were blowing off the barn, and this was a huge barn. It was 70 feet long. These barns in North Carolina are not nearly as big as a dairy barn in Wisconsin. The barns in Wisconsin were up on these big stately foundations that were 2 feet thick of fieldstone, but those fieldstones were granite. But this barn was going to cost about $15,000 to get a new roof on. I bought a couple of squares of used shingles at the Restore. They were $5 a bundle. That's about $15 a square. And my boys and I patched up some places on that old barn, and we stopped the leak, and we bought some time. And that cost us about $100 in a day's work. So there's a little rabbit trail, but don't let leaky water flood you and ruin your budget. Don't do it. All right. we want to talk about their $12,000 in credit cards, because this is where most people get into the deepest trouble with the credit cards. They owed about $12,000. Notice at the bottom that the minimum payment is $1,188. And the actual payment that we're going to work with is just $126 more at $1,315. So keep those numbers in mind. I'm going to say $1,100 and $1,300 to be efficient as we go through this. Now, the 1100 is at the top of the page, and without the snowball, they'll be paying for at least 204 months, and they will pay $56,800 in interest. That's the number at the bottom of the page, without the snowball. If they make their minimum payments, when they get the bills, they're going to pay off the debt and $56,000. Now, how much was their debt? Do you remember? Let's go back. Their total debt is $100,000. There's $88,000 in fixed term, $12,000 in credit cards, and 88 plus 12 is 100. So to use $100,000 for 200 months, they're paying $56,000. That's a big number. However, if they snowball and they don't pay anything ahead, notice here at the top of the page, the monthly payment is still $1,188. And the initial snowball is, there's no additional payment there. But if they just roll over, pay off that bill and roll over that payment to the next bill, and don't take on any more debt, now they've got it down to $38,000 in total interest over 113 months. How many months was it previously? It was 204, and 204 minus 113 is about 90 months savings. So that's a lot of years. And what is 56,000 minus 38,000? Well, it was no extra money every month, but they saved about $18,000 in interest. They can save a lot more than that. Let's look at what happens here. What happens if they pay an additional $126 a month? That's just rolling up this payment, rolling up that payment, paying a little bit ahead on those payments. If they pay a little bit ahead each week or each month, the months are down to 79 and the total interest is down to $20,000. So the rule of thumb here, don't borrow for anything that is disposable. Meals are disposable. You can't use them. They're not durable. Now, we've got to have them to eat, but don't borrow for that expensive meal that you eat today, because you'll end up paying for it for years to come. Make your minimum payments. When a payment goes away, take that previous payment that you don't have to make now and apply that to some other debt, and that will help your debt to go down quickly, and you'll save about 1/3 of the interest. If you want to save another 1/3, just round up your payments a little bit. Remember that number down at the bottom says 20. Several slides back, it said 56. We saved $36,000 by snowballing, rolling those payments ahead, and paying a little extra each month. Now, the avalanche versus the snowball goes back to, do you pay the highest interest rate down first or the lowest balance? If you have the discipline, the highest rate is your best way to go. Now, once they paid down this debt, remember they were paying $1,300 a month for the debt. It took them about 8 years or so, 79 months. I guess that's closer to 7 years, to pay off the debt. Now they have $1,300 in their pocket, in their hand each month that they're not spending. If they start saving this money from age 42 to age 62 at a very modest rate of return, 6%, they'll be millionaires at age 62. Any of us can become a millionaire if we save a portion of what we make beginning early in life. Now let's move to protection. We're going to review some verses here as we go along. But protection is planning now for expenses that are going to happen. We just don't know when. Genesis 41, Joseph has a dream, and Joseph is helping out Pharaoh, and he says, let Pharaoh do this and appoint officers over the land and take up a fifth part of the land of Egypt in the 7 plenteous years. Remember the story? They were going to have 7 years of fat. The cows were fat, and 7 years of famine. So Joseph told the king, Pharaoh, the boss, to collect 20%. That's 1/5. 20%. Remember, I told you if we put away 10 to 15% of our income, we'll always have enough income to live. He says 20%. They're collecting food. Some of that food's going to waste. Rodents are going to get in the storehouses. There's going to be some waste there. And they also have to pay for the administration of the government. So that's a good reason for 20%. But the Bible does say 20% there. And let them gather all the food of those good years that come and lay up corn under the hand of Pharaoh, and let them keep food in the cities. Notice verse 36. And that food shall be for store to the land against the 7 years of famine. Why do we have a reserve account? Because famine is going to come. I don't know how your famine is going to be spelled. It might be spelled flat tire. It might be spelled broken washing machine, or your house burns down. I don't know. Maybe you get sick, or maybe your job shuts down. Maybe you're working in food service, and a friend of mine just closed his restaurant. He'd been open about 20 years, but the franchise was up for renewal. The lease was up for renewal. Corona came along, and he said, I'm 60 years old. I'm finished with this. And all those employees are no longer working for him. So put it away, and that the land perish not during the famine. The bottom line there is that we don't perish whenever things are scarce. There are 2 types of insurance that we want to talk about. Now, we can talk about insurance from a number of perspectives, but there are 2 types. One is self-insurance, that's a reserve account, and the other is purchased insurance. Now, please understand that insurance and investments are 2 different things. They can overlap, but generally speaking, insurance is where we pay a premium, a guaranteed loss. I owe $100 a month for my Medicare. That's a guaranteed loss. And in exchange for that, they're going to pay the 20% that Medicare doesn't cover. So the Medicare supplement covers 20% and Medicare covers 80%. But that's got a guaranteed loss of $100 a month. We trade the risk of that 20% of unknown for $100 a month. That's not an investment, folks. Here's a tip. Whenever you're deciding whether or not to buy insurance, I went to Walmart yesterday and bought a ceiling fan. It's sitting over there in the corner. Maybe I'll install it this week before you come back next week. It was an $80 fan, and it was on clearance for $40. They asked me if I wanted to spend $3 on product insurance that would insure that for 3 years. Now, can I afford the risk more than the insurance? Could I afford $3? Sure, I can afford $3. I can also afford to come back in a year or 2 and pay another $40 for that fan. What is the probability that that fan will break on its own, not because I threw a shoe at it or it hit my head? And those things have happened. Not that I've thrown a shoe, but the kids have. But I have hit my head with a ceiling fan. What is the probability that the fan will break on its own? This is called product or purchase insurance, and we'll talk about that more in a few minutes. But can you afford the risk more than you can afford the insurance? How about this house? I spent some money on this house. It's just a house. It's not a big deal, but it's easy to have $150,000 in a house. I can afford the 87 or whatever dollars a month it costs me to insure this house, a whole lot more than I can afford a $150,000 loss. Now, if you have a mortgage on your property, the bank insists that you have insurance on their loan. I always find it interesting that people will pay insurance for their car and insurance for their loan, but they don't have insurance on themselves. And if they don't come home from work, the family can't afford to make the loan. And so the family loses the house and the car. That's called life insurance. So can you afford the risk more than the cost of the insurance? Self-insurance. Let's talk about the cash reserve. There are all kinds of names for this cash reserve. Grandma called it her rainy day fund. She kept money under the mattress for this, but it's a personal reserve. It gives you peace of mind. Some people call it their financial freedom fund. That peace of mind makes you financially free to walk away from work because you've got 6 or 8 months of living expenses in the bank and work has driven you crazy forever. And you can walk away. You are financially free. You're not in bondage to your employer because you have enough money to pay your bills for 6 months and you believe you can find other employment. Now, I don't recommend that you just walk away from work, but this financial freedom fund gives you confidence to do some things because you have financial backing. And it's under your control. You don't have to ask permission to do it. You don't have to apply for it at the bank like you do a loan. It's in your pocket and you can choose when to spend it. Now, a friend of mine is a CPA and we were talking about this and he told me the story. It is a true story, although I won't tell you the names to protect the innocent. He said that his nephew came to him. His nephew was in his early 20s and really struggling with money, but still living at home, making a lot of money, but he didn't have anything. And he asked his wealthy uncle, the CPA, over and over, what? Tell me what to do. And the CPA said, go save $500 and come back and see me. That summarizes it all. If you can't keep your hands on $500, that's a problem. So go save something, then add to it. And whenever you learn that personal discipline of holding on to something, it's not a greased pig, it's just a dollar bill. Here, I have $10 here. It's just a dollar bill. If you can't keep your hands on this without it becoming a Big Mac or a coffee or a smoke or something, if you can't keep your hands on this, you got a problem. Okay, now maybe you don't have much income. If you're making less than $20,000, you really might be struggling to survive in our society. But if you're making 30 or 50 or 150 and can't keep your hands on $10, this is your first problem. So here's your tip. Put your $10 in an envelope and leave it there. That's a big tip. Have you heard it before? So save $500. This young man went home and saved $500. It took him a couple of months. As the story goes, the young man went home after talking to the uncle and lost his job. And that $500 was enough to get him through about 3 months until he got another job started. And he never borrowed money and went in the hole after that. Just $500 glued that young man's life together between this mess that he had and losing his job and getting started. And then he saved some more, and then he saved some more. The rule of thumb is to have at least 3 months living expenses, and that's after taxes, but 3 months of living expenses minimum. Most of us are far more comfortable having 6 or 9 or even 18 months. If you work what I'll call a simple job that's easily replaced, that doesn't mean that it's not a professional job. Even a nurse, generally speaking, nurses are highly trained, but they can get rehired within a few weeks. If you have that kind of job, a smaller emergency fund might be okay. If you are very specialized or very unique, you're more likely to be without a job for a longer period of time, so you should have a larger emergency fund. All right, self-insurance gives you peace of mind. It's available without external approval, and it helps you to remain calm and carry on while you build the next strategy and kind of gain traction again in life. People who don't have a reserve fund tend to go deeper in debt when the income slows down or stops. Now, purchased insurance is another thing. It is a method of buying financial security. Some of this financial security is essential, and some of it is simply peace of mind and optional. The guaranteed cost is a certain loss. Every month when you pay that premium, it's a certain loss. It's called a premium. And it covers uncertain losses. So the certain loss is the premium. The uncertain losses are often catastrophic. When your house burns down, that is, you didn't see that coming. and it's called a risk. So we trade this certain loss for the uncertainty. That's called transferring risk. And we transfer the risk of financial loss to the insurance company. Now, the insurance company has a lot of numbers on these, and they can predict how many they're going to pay out. They don't know if you're going to die this year or not, but they know how many people your age are probably going to die this year. Likewise, they don't know if your house is going to burn or not, but they know how many houses burned last year, and they have expectations about that. Interestingly, we don't have to wreck our cars, and our houses may never burn, but we have yet to see very many people, except in biblical history. But we don't have records of very many people who didn't die sooner or later. So types of insurance we have are purchase protection. That's the kind of thing that I mentioned a moment ago about my ceiling fan at Walmart. The one of these that I've had a lot of discussion about is the cell phone. Lots of times if you buy insurance on your cell phone, there's a $100 deductible, and then you're paying $10 or $15 a month for the insurance. So at the end of year one, let's say you're paying $12 a month in insurance. You've paid 12 months of insurance. That's $144. There's a $100 deductible on it. That's $244 that you've either have spent or will finish spending before you can have a repair done with the insurance from your phone. So you've already spent $244 on insurance for something that's worth a couple $100. That's half the price of it. It's not a very good value, but many people buy it because they want that peace of mind and they believe that it will give them financial freedom. I'd rather buy a used phone. I don't carry insurance on my phone. Oh, I missed it. Health insurance is essential. We have to have some level of health insurance, but we can save a lot of money on our health insurance if we're buying it ourselves by buying a higher deductible plan. That's not just for health insurance, that's for everything. It's for your cars, your houses, anything. If you'll raise the deductible, that's the amount that you spend out of pocket before the insurance company pays. But if you'll raise the deductible, then you can lower your premium quite a bit. But don't raise that deductible if you don't have the emergency fund in place to cover it, because then you'll be stuck and you'll have to borrow the money. Now, life insurance comes in a lot of different forms. Many people think that accidental death and dismemberment insurance is a wonderful thing. I was talking to someone yesterday while I walked through Walmart with that ceiling fan in my hand. They called and they told me how many hundreds of thousands of dollars they had in accidental death and dismemberment insurance, and it cost them $13 a paycheck. And I said, that's fine, but just remember, when you die, it has to be by an accident and under only these circumstances. That's why AD&D is so inexpensive. There also disability and long-term care. Excuse me, I want to sneeze, and I didn't. Disability and long-term care may fall under the categories of life insurance. Annuities are used for pensions and long-term income during retirement. Those are also a form of life insurance, and they may come in annuity contracts, or they may come as riders under the life insurance contracts. I do work in life insurance, and one company I work for has about 10 or 12 different riders that you can attach to their life insurance contract. And that makes them do a whole lot more than just life insurance. So be sure to understand what you're signing and the benefits and the consequences of the choices that you make. If you don't understand those, call somebody who does. Find out what you've got. Now, P&C insurance, or property and casualty insurance, is where we insure stuff. It's where we insure our houses and our cars and our big toys. We used to have a four-wheeler or a boat. I want to buy a camper here soon. Those are sometimes called toys, and jewelry, expensive things. I got a grand piano on the other side of that wall, and it's insured separately from the house because it is a very valuable piano. And if we had water damage in the house, it could cost $10 or $20 or $30,000 damage to that piano. So it has a separate insurance on it because it's more affordable for me to pay $200 a year in insurance for that piano than it would be for me to pay the price of a new car to replace that piano. So moving on here. Some of the terms I've already used, but premium is the amount that we pay each month or each quarter or each year for our insurance. Now, here's a tip. Some of our premiums are automatically paid monthly. Inside the insurance business, those may be called financed because they actually charge you the premium for the year and then they factor in interest for each of those monthly payments. Some companies have a very high fee, $10, $15, or $20 a month for making a monthly payment. Other companies may charge you $1 or $2. That $1 or $2 is very reasonable to me because they have to pay to print a letter, print a bill, and process a payment. That's work, it costs money. But if you're paying $15 or $20 a month for them to send you a bill, maybe you want to work out some situation where you don't pay so often, and then you can save that $15 a month. If it's $15 a month and you could pay it quarterly, 3 times 15 is 45, and you still have to pay one installment charge there. So 45 minus 115 leaves you $30 extra that you could have in your pocket if you paid quarterly instead of monthly. Deductible is the amount that you pay out of your pocket before the insurance company pays. Now, there are other words that are similar to deductibles, like on a copay. If you have a particular health insurance plan, maybe you go to the doctor and pay them $10 or $30 or $200 before the insurance picks up. That's your copay. It's like a deductible. It's what you pay out of your pocket before the insurance company pays. There's also co-insurance. We mentioned Medicare earlier. Medicare covers 80%. The individual is responsible for 20%. That's a co-insurance. Then there's an elimination period. That is a form of deductible. If you have, say, a disability insurance, maybe there's a 90-day or a 6-month elimination period. And you need to know what this is, because if you become disabled, that disability insurance will not pay you until you have been disabled for 6 months. Well, how are you going to pay your bills for 6 months? That emergency fund comes in and it covers your bills. And then be aware, because that disability insurance may only cover 60 or 70% of your normal income. Why that amount? Well, taxation is part of a reason. But you need to be prepared, because the insurance company doesn't want to make you rich because you're sick. But the problem is, when you're sick, your expenses go up because you need extra care. You need someone to take you to the doctor. So your cost of living may go up, but be aware of that elimination period, which is like a deductible. Some insurances work on a reimbursement basis. That means you have to pay the expense out of your pocket first, and then the insurance company sends the check to you. Of course, other insurance companies send the check directly to the doctor or whoever caused the charge. On your insurance policies, there may be endorsements. I'm thinking particularly of property and casualty here. Endorsements would cover additional things like jewelry, barns, buildings, things like that. And there may be exclusions. Make sure you know what those exclusions are. The big exclusion in homeowners is flood insurance. And if your home is in a floodplain, you may need an additional insurance for that. Time is running short on us, so I'm going to speed up a little bit here. But indemnity is yet a different type of insurance that kind of works on a reimbursement basis. But for example, hospital indemnity. If you go into the hospital, maybe your health insurance pays for all the hospital, and the indemnity gives you $200 a day because you were in the hospital. Well, why do you need that $200 a day? It pays someone to take you to and from the hospital. It pays for your vet to be in the kennel. It pays those other expenses that you incur while you're in the hospital. So here's your homework for protection. You want to make a list of all the money you're spending on insurance. That's the second thing. The first thing you want to do is look at your self-insurance. How much is your budget, and what's your target for your self-insurance? Start with $500, then save up to $1,000, and then figure out how many months of expenses you need to have in the bank. I highly recommend you have at least 3, 6 or 9 is much better, and a year is better than that. Then, of course, you want to list your insurance expenses, including the premiums and the deductibles and whatever other words you have for those deductibles. You fill in the blank, but you list your exclusions. If if you've got valuable jewelry and your homeowners only covers the first $1,000, you want to write that down, because then you want to think about, do I have the money to cover this loss if it happens? Many times whenever we lose something like jewelry, it's more of an emotional loss. This ring that I wear, my dad had this ring made whenever he gave my mother a second wedding band. So these stones came from her first wedding band, and this is my father's second wedding band. So this is my dad and my mom on my finger. I have no idea what this ring is worth. It doesn't have a dollar value to me, but I wear it because it's been around all my life. Those stones came before I was born. So there's a lot of nostalgia and memory there, but there is a price for that. Now, takeaways. Here's some money-saving tips. What about protection? How much minimum reserve do we need? Do we need more in the future? That might be a target that we need to adjust. Do I need the insurance I have? Do you need to be paying insurance on your device or your toy or your habit or your plane ticket or your luggage or whatever it is? Many times if you buy a plane ticket with a credit card, excuse me, that credit card comes with insurance on your luggage or your accidental death, common carrier insurance. Many of that's included with the credit card paying for the ticket. So it might not be a good idea to buy additional duplicate insurance. What insurance do I need? Are there any gaps in my insurance? Do I have any exposures that aren't covered? And what insurance should I avoid? And I always ask, what more do you want to talk about? Just let me know later. Now, in the next couple of weeks, we're going to talk about investing and a stress-free legacy. And there's still time to invite a friend. So I want to encourage you to invite your friends and get them on board. We only have 2 more weeks of this unless something unexpected changes. And we've had a lot of changes in the last couple of months. Next week, we're going to be talking about future income, which is saving and investing. And I still want to challenge you to be writing down and thinking, are you dreaming about how your future can be different in just a year? 5 years, 15, 25 years. Be thinking about those things and write them down. If we write things down, it helps us achieve them. Now, that concludes our seminar for today. We are open for questions. You can email us at opendoorarchdale@gmail.com. You can also email me at Dr. Jeff Crum, DrJeffCrum. That would be jeff@drjeffcrum.com. We'll get your email there and we'll respond to you as soon as we can. I thank you for coming. And now we'll stop the recording and we'll have some individual questions from those attending.